All right. Hello, everyone, and welcome to the Macroeconomics Hour session on Sunday, April 14th. Tomorrow is the tax deadline, right? Sort of hopefully everybody's done their taxes already. And let's jump into it. So today we are going to be discussing climate change and real estate, as well as the persistent inflation. So I'll start with climate change, and Hadi will end the session with discussing the persistent inflation issues. And let me start sharing my screen in one moment. All right, and here we go. So hopefully everybody can see my screen okay. Let's talk about it. So climate change and real estate. This is an interesting topic, one that is hotly debated in the United States, right? There are certainly quite a few political overtones to this discussion. But essentially, climate change, it's the idea that you have more extreme weather events. You also have increased costs of managing overall climate change, such as warmer temperatures, right? And extreme weather events tend to be fairly expensive, and they seem to be happening more and more often. If you think about what it typically costs you to deal with it, there is the issue of remediation when something happens, fixing the damage. And then even before that, typically you want to invest in preventative measures. And so that tends to be a fairly costly program as well, right? And so right now, I think in many countries, what you're seeing is a lot more efforts on remediation in general after something happens. And that also tends to serve as a catalyst for change for government policy. You have those big events taking place. They push the governments to do something in response to significant costs. But generally speaking, if you look at the frequency of those events, that frequency had been increasing quite a bit. The example that The Economist used is weather events that result more in $1 billion in damage in constant dollars. If you look at the first decade, starting in 2000, there have been only 3 events worldwide of that size. In 2010 through 2019, there have been a total of 10 events. So this is a significant increase. And if you look at the current decade that started in 2020, we've had 6 events already by 2024, right? Sort of, the expectation is that if it goes at this rate, we'll probably see somewhere around 12 to 20 events, right? It's a very significant increase if you look at it. MSCI, sort of, which is a research firm, estimates that the cost of climate change will be roughly 10% of the value of housing that institutional investors hold in those portfolios. And if you extrapolate those numbers to the rest of the world, whether or not, and again, this is not exactly an exact science, right, with extrapolation, but extrapolation gives you a very nice yardstick for what it might cost you, right? So if you're looking at roughly a cost of $25 trillion, which is a huge number, this is 9%, 10% of the world's housing value overall. And if you want to compare this value to GDP, this is roughly equal to what United States produces as its GDP during a given year, during the most recent year, right? Or if you compare it to the rest of the world, that's basically about 25% of the world's annual GDP. So these numbers are staggeringly high, right? And I think this is where that comparison to GDP makes a lot of sense, because people generally don't tend to process very large numbers terribly well. This is one of our behavioral things, I guess, right? But putting that as an equivalent of the GDP numbers, I think that really does bring the point home quite a bit, right? And so sort of, why is this such a huge deal? Obviously, real estate is a very important class of assets. Estimates is that if you look at all of the wealth worldwide, real estate will account for roughly 2/3 of it. If you look at the United States, and the United States actually does a little bit better in terms of reliance on home equity for GDP. If you look at the median household wealth, right, Median household is the household that is, half of the households are below it, half of the households are above it. We're looking at real estate accounting for about 2/3 or 65% of a median household wealth. If you look at all of the assets in general, that accounts for roughly 35%, right? Because sort of if you're looking at those folks who have higher than median household wealth, they rely less on housing, but still 35% is incredibly high. If you look at China and China's home equity, that's probably about 60 to 70%. So it could be perhaps twice as much as in the United States overall in terms of reliance on real estate, right? And so I don't know how well you can see how well you can see this right here. This kind of is a nice comparison of China. Eurozone is a little bit worse than that. So Eurozone relies on housing quite a bit in terms of wealth. UK relies on it even less. United States is here at this figure about 35%, but still those numbers are considerable, right? And in China, if you think about, sort of like some of the things that push China towards that higher percentage, it's a country where, there was really no consistent social security net for workers, right? Even sort of the comprehensive social security type system in China had been introduced maybe what is it about 12 years ago. Still, not everybody is covered by that, and people who essentially didn't have a lot of trust in the banking in the country, they would accumulate their assets in their in their home equity, right? This is how you save for the future. And so this is one of the reasons why for China, real estate movements are so incredibly important. And there are still countries where reliance on real estate might be even higher, right? Sort of China is relatively high, but there are certainly a number of countries where there is even more reliance. And let me actually pull up the chat to see if there are any questions, but feel free to, sort of if you have a question as you go along, feel free to stop me and ask those questions. I very much welcome them, right? Sort of I hope that we have more of a discussion rather than the one actor theater here. Okay, all right, but let me move on to my next part of the presentation. So continuing to talk why this is such a big deal. Sort of this impacts the financial system quite a bit, right? If you look at the assets of United States commercial institutions, or financial institutions rather, they have very significant exposure to mortgages overall. So mortgages that are collateralized by real estate in their portfolios. And if you look at the data from the fourth quarter of 2022, and it probably hasn't changed very much since then, you can kind of see that residential real estate accounts for roughly 10% right here, right? Commercial real estate accounts for another 10.07%. So we're looking at something like 20% of the bank's portfolios. But if you consider that banks in the United States don't actually hold a lot of mortgages on their portfolio themselves, because very often their model tends to be originate and resell. A lot of those mortgages, close probably to 2/3 of all mortgages, end up as holdings of the government-sponsored enterprises, huge corporations with lovely names of Fannie Mae and Freddie Mac, right? Sort of you hear Fannie Mae and Freddie Mac, and it suggests to you kind of like this, sort of like very traditional loving farmer couple, right? I mean, this is not a farmer couple, obviously, right? These are huge corporations with incredible amount of assets and an incredibly important role in financing of the real estate market for residential real estate, right? So if you actually put, remember, this is, sort of, I mean, I guess the point that I'm making here is that the reliance of financial institutions on real estate and on real estate-backed mortgages, both residential and commercial, is very significant. So when something starts happening to the real estate and real estate risks, it will impact financial institutions quite a bit. And what might that adjustment be? So think about it in terms of repricing of collateral values, right? If the banks decide that goodness, sort of to account for those risks, the value of the houses has to be shrunk, right? Or we have to include additional costs and repricing of those mortgages. That basically means a significant change in financing. This repricing of mortgages, the repricing of real estate, can easily lead to bailouts, can lead to pressure on the governments. It can lead to significant personal and commercial bankruptcies. The impact is really kind of hard to predict, but we know for sure that it's going to be extremely significant, right? Okay. Sort of we could certainly see situations where climate change, and perhaps it's not necessarily the gradual climate change, but it's the climate change that is perpetuated by big spikes in events, right? If you have a couple of significant weather events happening, and a few of them happen in a row, like Hurricane Sandy, for example, which led to significant repricing of risk on the East Coast. We could certainly see significant property crashes and extreme amount of pressure on the financial system. And so the question here is, are those risks actually reflected in pricing of housing? And in the United States, they don't actually seem to be. There are some anecdotal examples here. For example, if you look at Miami, all right, so the prices in Miami increased by roughly 80% in the last 10 years. And Miami is one of those areas that is likely to be impacted by climate change more than anybody else. If you look at some of the recent research that's been published, for example, there have been an article in 2023 in Nature magazine that suggests that residential properties that are exposed to flood risks are overvalued by somewhere, and this depends, of course, on the discounting rate that they use in the article, but depending on those discounting rate assumptions, it's anywhere between 120 and $240 billion, right? This is extremely significant. Those risks are becoming apparent relatively slowly. As I mentioned, typically what happens, I can't really say typically, but there have been examples like Hurricane Sandy. You have a big event taking place, and this becomes a catalyst for repricing. In some sense, the same thing is happening in Florida as well, because the insurance rates in Florida increased quite a bit over the last few years, and it's really the few big hurricanes of significant risks that gave rise to those repricing changes by many insurance companies. And we also see quite a bit of an uneven spread of those risks. Typically, one of the examples I think that the Economist article cited is that if you look at the United Kingdom, taking a more global view, it's basically roughly 10% of properties or 10% of the zip code districts that account for close to half of all significant repricing risks. So that is there as well. And so how could we reduce those risks? Well, improving preparedness obviously is very big, right? And that involves a number of changes. You have to change the way how you approach infrastructure in order to be prepared better for those extreme events. You have to update the property construction standards as well. You have to price your insurance closer to what the market would charge, right? And I think this is one of the current problems because, of course, we keep talking about how good the markets are in pricing, but in many cases, in many areas, we don't let the markets price insurance for climate risks correctly. For example, if you look at Florida, an insurance, there is such a system as insurers of last resort, right? This is in some sense similar to the Fed being the lender of last resort to banks, right? In insurance, it's certainly logical that we want to have a system where a household that cannot obtain insurance commercially, could turn to some sort of a state agency. But the question is, how much of a benefit, how much of a subsidy should the state-owned insurer provide to those consumers that remains open. But in Florida, we have the issue where this state-owned insurer of last resort, Citizens Property Insurance Company Corporation, actually is the largest home insurer in the state, right? And there is also a couple of other states in the country that are starting to approach that. So even though the Florida's average annual premium, which is about $12,000, and I'm curious, sort of for those of you on the call, how much are you paying for your annual insurance premium? Do you want to voice out what your payments are?
Yeah, mine is all my insurance, house insurance total is
Uh-huh.
half of my property taxes. And it's just getting to the point where I just hope I'm not priced out of California.
Yeah, yeah, and California is one of those places that is impacted quite a bit, right? And
Mhm.
California also has a process of insurers actually applying to the state insurance commissioner to essentially approve their rate hikes. And recently, the state insurance commissioner had been withholding those approvals, right? And what is a company to do when something like that happens? What are the choices that you have? Well, like State Farm, you could just say, you know what, we're not going to be issuing any of the new policies. And for the policies that we do hold, there is a pretty high risk, there is a pretty high chance that we're going to ditch and abandon those and potentially abandon the entirety of the state. We've seen a number of insurers leave the states of Florida and California, which is where a lot of those risks are concentrated, right? So I certainly feel your pain, Julie, if you're in Florida, right? I just looked up right before this what my townhome insurance is, right? And for townhouses, um, essentially it's kind of like an equivalent of a renter's insurance, right? Because what you're insuring is the stuff inside of the house, and it's your HOA that's responsible for insuring the building structure as such, right? And so, sort of my payment, I think last year was less than $300. But even in the state of Illinois, right, sort of those rates are increasing quite a bit because I think where I started a few years ago was something like a little more than $100. Well, actually, it's not. Yeah, it's annual, so it was a little more than $100 initially, and it rose to $300. Sort of over the course of about 10 years, and the last jumps were relatively recent, right? Where it was a jump from roughly $200 to $300 in a year, which is a 50% increase. But obviously, for housing, that's going to be a lot more. But again, in Illinois, nowhere as close to Florida and California, where the risk
Mhm.
is supposed to be much, much higher, right? And so, sort of one of the ideas in here, of course, is that, sort of, and, in terms of pricing the transition risks, it might be as the European Central Bank approaches it, right? It could be differential pricing for your green mortgages versus your brown mortgages. A green mortgage is essentially for a house that fully meets the expanded requirements of surviving extreme weather events, right? Those transition risk costs of getting your house to meet that requirements for a green mortgage are going to be much higher. And so essentially the idea in here, if you are in one of those green properties, then your insurance rate typically will be priced lower, right? If it's a brown mortgage where a lot of those transition risk costs are simply not impacted, we can generally increase those rates, which will allow two things. Number one, it will give it will price the risks better for the insurance company relevant to what it costs, right? And number two, it will give a push to the house owners to essentially engage in those transitional activities to move their house away from the brown category and towards the green category, correct? Yeah. And so I'm looking here at the chat, on my other screen. So Nadim is mentioning he is about sort of $3,000 now in Virginia, and used to be about $1,000 10 years ago. So overall, a 200% increase over 10 years or so, which is pretty steep, right? And I'm guessing that a lot of those hikes probably happened in the last 2 to 3 years. Hima and Hadi are also saying, okay, around $3,000, whether, sort of depending on whether you have earthquake or not. So these
The
are,
earthquake for us, the third earthquake would be something like $5,000.
uh-huh.
So
So which
3,000
is
for
a
the
huge
regular
premium.
so far and 5,000 for earthquake. So we did
Yeah.
the earthquake. Living dangerously.
All right, that's right. That's yes. And Hadi, you don't strike me, sort of as a risk-loving person, right? But yeah, I think, sort of there is quite a
Is the
few
price.
households that are making those changes, and quite a few households in the flood zones that simply don't hold the flood insurance, right? That's a significant, significant issue. And given that the flood insurance is typically quite a bit underpriced compared to the actuarial value of flood damage, that does tell you quite a bit, right? And so, in terms of regulation, regulating those climate change risks, there is a number, of examples of emerging regulatory frameworks. For example, central banks from 8 countries formed a network called NGFS back in 2017, which by now I think expanded to more than 100 members, not more than 120 members now, actually. Approaches to climate change regulation are different between different banking regulators. The ECB, unsurprisingly, tends to be, sort of more aggressive on making those changes, and sort of, the discussion of differential pricing of green versus brown mortgages that does come from the ECB, European Central Bank initiatives. The approach that the Fed is taking. And so I am assuming that probably quite a bit of that approach comes from the different political environment where there is a lot more skepticism about climate change in the United States compared to Europe. But essentially, the standards that are being built exclude any support for decarbonization initiatives, which are some of the longer term preventative initiatives. So there are things happening. The question is that, are they happening quickly enough, right? Do we expect to see a lot more different different crises, which will give risks to significant changes in those regulatory frameworks as the population realizes the risks inherent in something like this, and as the market adjusts their prices, right? There are a lot of good questions to be asked here. And sort of, I think in many ways your guess might be as good or maybe even better than mine in terms of how we will expect to see this changing. Again, my bet is that there is going to be significant events happening. We are pretty much guaranteed to see this. And those significant events will probably give rise to more popular support to some of those initiatives, and thus, sort of more aggressive approach to reducing those risks. But again, we'll have to see how this is going to play out for us. And that's all that I had for you folks. I'm happy to take any questions or any comments. If you'd like to share, please go ahead and unmute yourself. I'd love to hear your take on this issue. All right, all is quiet on the Western Front, I guess.
I do have one question. Are there
Uh,
any special regulations in terms of permitting new buildings, especially in California? I don't think so, because I have seen some new homes coming up, and I looked online for the fire risk, and it said 85%, and they're building new homes there. And I'm wondering, how would they even get permissions for such zones?
And that's exactly the point, right? Sort of, those permitting standards, they vary a lot state by state, right? And, sort of to this day, one of the criticisms is that, sort of the states don't seem to be taking the climate change risks into, don't seem to pay those risks a lot of attention when setting those standards. And that's an issue both for the state and for the municipal governments, right? And for municipal governments, there is often, quite a bit of a conflict of interest built into this, right? Because, if you are a municipal government, you rely on your real estate taxes for your financing. That typically makes up a very large chunk of your income. And so for you as a municipal policymaker, there is a bit of an incentive not to make those standards too strict, right? Because doing so will lead to number one, decreases in the number of houses built in your area and thus a reduced tax revenue. And number two, it could actually lead to the decrease in prices for existing houses. That's also a possibility. And that decrease in prices, if the tax burden overall doesn't changes, that means significant increases in the property tax rates. And in many states, these are also limited, right? Sort of like in California, there is, if I recall correctly, there is a standard by which your real estate taxes could increase, right? Is that 2.5%? Am I recalling that correctly?
2%, I think 2%.
No, Proposition 13 is 1%
Mm-hmm.
in California. But then what happens is that then they add on all the city taxes. So
Mm-hmm.
and school bonds and fire. And so it ends up to be around 2%, I think, or maybe just under.
Mm-hmm. Yeah. So, so the incentives for the local governments are not really great incentives, and they're the ones who often lead to less than optimal outcomes, right? This is where incentive design really matters quite a bit.
Thank you. That helps
Great
for me to
questions.
understand how would they even get permits now. Yeah.
That's right. That's right. I mean, it's, think of incentives, right? And sort of incentives, sort of this is what economists emphasize in the analysis. Incentives is what matters.
Mhm.
All right, very good. Any other questions or comments, folks?
So, Professor, there is something called like I don't know what I think there is a government level insurance called National Flood Insurance, I believe. And how does that work? And with the climate change, we may expect to see more areas affecting by flood, and how it's going to impact economy, because I'm assuming that government has to pay from its pockets to cover the cost for rebuilding those areas which are affected, right?
Yeah, that's right. So this is one of those programs that is criticized extensively, right? So it tends to be very popular in terms of people's interest for something like that, right? To obtain the flood insurance from this government-sponsored program, and this government-sponsored program doesn't reflect the risks correctly, right? So I don't recall the specific numbers, but if we were to price the flood insurance risk better, those premiums would be a lot higher than they are right now, right? Sort of, if I recall correctly, some of the estimates suggest that they might have to be twice as high, which is extremely significant for many households. And the reasons why, sort of the program is priced in this way, these are very much political economy reasons, right? It doesn't make sense for any federal administration to say, oh, let's reflect the risks correctly, because this will become a major issue for the voters. And if a Democratic administration does that, they'll vote out the Democratic administration out the next time. If it's the Republican administration that does that, despite the Republicans, sort of market orientation, at least nominally, sort of in the Republican tenets, again, they're going to get voted out in favor of the Democrats. So nobody really wants to make that decision and to take that courageous action, right?
And
so, yeah.
I heard that, yeah. So in some cases, government will provide assistance in the event of a disaster, even if those houses don't have insurance, right? So I'm assuming this will also add a cost to government expenses, right?
Yeah, absolutely. We can expect bailouts, right? Because if the issue is significant enough, sort of again, political economy reasons, the governments will take steps to bail out those homeowners, because sort of again, they don't want to get voted out of the office, right? That's a concern. And of course, it's sort of people say, oh, it's the right thing to do. It's the right thing to do. I mean, might or might not be the right thing to do, unless of course you're impacted. Then your opinion of that changes. But for the population that is exposed to the flood zones, you will see a lot of really, really strange outcomes, right? Sort of, there have been houses in some flooding areas that basically get, sort of rebuilt or get $150,000 put into them every few years once they get flooded, right? And sort of, the value of premiums that they collect is nowhere even close to the cost of rebuilding them. Unfortunately, sort of, I haven't seen a significant change in the flooding insurance lately or flooding insurance initiatives lately. But ideally, I would absolutely love to see it priced closer to the actual actuarial cost, right? Something that doesn't essentially create a handout from the rest of the population to the folks who insist in living and rebuilding in the flood prone areas.
Yeah, and it may not be a popular opinion, but shouldn't government discourage people rebuilding in those areas which are prone to
Yeah,
natural
it's economic efficiency, right? I mean, sort of you're better off rather than having this house, sort of that is valued $200,000 and where you have to rebuild or repair that every few years at a cost of $100,000. I mean, in many ways, it's better to say, look, we're just going to condemn this area. Here is a payment, sort of equivalent to the, price of your house, maybe even, a little more than the price of the house. Take it, go and buy somewhere else where you're not exposed to flood. But this is a tough decision to make, because essentially what that means is that we are condemning whole towns to to destruction, right? And people tend to be attached to the areas where they live, where they grow in. It's an extremely emotional thing, right? And people will, when emotions are concerned, people will very often behave as non-rational economic actors. Or, well, I mean, I guess they're still rational, it's just that there are different psychic costs and benefits that people take into account that are not apparent to the rest of us.
So can I tell you a story about California and how they will build anywhere and everywhere?
Sure, would love to hear it.
So my aunt, she lived very close to the Hollywood sign in Southern California, LA. And we would stay there as little girls all the time. And in the guest room was behind us was a hill, and on the hill were these huge stilts, and these houses were supported on stilts on a hill where we get really pretty severe, rainstorms. And I just refused to even sleep back there. And it lasted, I mean, my aunt was there 35 years and it never fell down, but I'm really, really surprised. And it also went through a couple earthquakes, but it just goes to show, I always thought sometimes, at least in California, where it can get really ridiculous at times, what they're willing to build on.
Yeah, that's right. That's right. And sort of this is a good example of that emotional attachment that we have to our houses. Some of it, I mean, I think all of us have that attachment to some degree, some people more than others. But yes, people very often are willing to take, rather significant risks. And again, in many cases, because, sort of individually, I don't think that they're built to evaluate the, sort of the long-term, risks terribly well. That can really lead to pretty poor economic outcomes.
Mm-hmm. Yeah, I think they wanted for the view. There was another point where, getting back to insurance, when I read my homeowner's insurance policy, it doesn't cover any act of God. So I don't know exactly what I'm paying for all this money, because if there is like an earthquake, I have earthquake insurance, so that's obviously an act of God, and okay, I'm covered there. But also I have a huge deductible too, it's going to take a bite. But the rest of the insurance I have, it's sort of like there has to be an accident in my home, they'll cover it. But if there is like a wildfire that swept through this area that burned down 90% of the city that I live in, fortunately my house was spared. That was in 2018 when we had this huge wildfires. That's not covered. So the insurance will get you, and I just don't know how they get away with it. So I think to Nadim's point where maybe you should, and I was thinking, why not? I don't believe in bailouts. I'm pretty conservative, but honestly, if you're paying for all this insurance, what's the harm for a bailout? Because you're not going to get paid anyway. You're not really covered.
Yeah. And I think, sort of the idea in here is that, even, sort of at those very high rates, what we are seeing is that it still doesn't quite cover the expected actuarial cost of events, right? So from the perspective of the insurance company, even with those exclusions, sort of you're not really getting very good value for your policy. There is a much higher, there is an extreme volatility to, sort of your expected claims, right? And sort of the likelihood is that you're going to lose money on many of those policies, especially when you bring those changes to the to the commissioner of insurance and in California, I believe that's what the office is called, right? And they essentially refuse to even allow an increase in those rates. You are, as an insurance company, between a rock and a hard place, and the only way for you to save money is essentially by turning to the homeowners and be as bad as you possibly can in denying the claims, right? Sort of to bring the revenues and the expenses close to each other, and that is also not quite optimal, right?
Yeah, so I mean, I do understand that position, and I do understand they're being squeezed because with these wildfires, I mean, literally, and that's where the jump occurred, and in the insurance, just I'm sure for all of California, even though it was more concentrated in the south and in the north, but even centrally. So and then I don't know about government policies and if they even. It just seems illogical. I don't know how else to say it. So, because it seems like everybody's getting squeezed and there doesn't seem to be an optimal solution.
Yeah, it's a tough place to be in, right? And so the changes in there, sort of, but at the very same time, is your city restricting where things can be rebuilt, right? Even after, sort of being mostly wiped out, but those wildfires, right? Have the decisions been made to significantly restrict the building? Have there been infrastructure changes to create, sort of to create mechanisms for preventing wildfire spread, right? Have there been changes in standards for building those houses? And the answer, unfortunately, to a lot of those questions is there probably hasn't been that change done, right? Sort of you're kind of continuing with the current system, and it's certainly not looking like it's going to get any better over time. If anything, it will likely get worse. All right, folks, you're at roughly 40 minutes in, so I'm sorry. I feel like I'm cheating Hadi of the time for his presentation.
That's fine.
So I'll transition this to Hadi. It is a fantastic discussion again. And if we have more questions, we can always come back to that at the end of the session if we have time. Hadi, it's all yours.
Thank you. Okay, let's see. Let me share this. And okay, I would like to talk about what's going to happen to the interest rates and how it's affecting the economy. This is S&P 500 index. And as you can see, there hasn't been much improvement over the past month or so, or in fact, if anything, there's been a decline from a month ago. So a small one. And in fact, on Friday, we had a drop in interest rates in the market because of rising interest rates or expectation that interest rates will continue to rise, long-term interest rates. And short-term interest rates, of course, have been kept constant by the Fed. So the key question here is, are we going to see these kinds of drops further in the stock market, and also rises in long-term interest rates in the coming months or not? And to do that, let me just go over a few indices and see how they're doing and what's happening. The red line here is the consumer price index, inclusive of all items, and the blue one is core. And as you can see here, what happened was that over the past several months, inflation has been going down, but lately there hasn't been much improvement. And in fact, the last month, for February, the indices jumped up, for especially the one inclusive of energy. And that's what concerns a lot of people. And as you can see here, there hasn't been since the late 2023, there hasn't been much improvement in inflation. Inflation hasn't gone down. And some people have been arguing that that's partly because inflation measure includes a big, heavy weight for owner-occupied housing, and the way it's estimated, it may be flawed. In fact, if you take into account that factor, you can just take the shelter component out of the index, CPI index. And as you can see here, although the inflation for those items, non-residence items, non-shelter items, were growing pretty slowly mid 2023, that rate has been going up. So the overall index has been stagnating, and the index without the shelter has been rising over time. And that's my key concern. I think what is happening is that inflation is spreading across many products, and it's becoming more difficult to control. It's not concentrated. Initially, after the pandemic, there was supply chain disruption and problems with that. It sent a shockwave through the economy, and some items suddenly experienced a jump in price. And a lot of people were thinking this is temporary, transitory, and just a few items, and now it seems to be spreading all over. And that's what probably forces the Fed to act further rather than easing the interest rate. Monetary policy may have to keep it as constant, and this is unlikely that they will raise interest rates in the coming 6 months or so, but that if the trend is as has been in the past few months, this continues and inflation comes back, or seems that it's going in the wrong direction, the Fed may have to act in terms of tightening monetary policy rather than easing it. Okay, now, what's the expected inflation? What does the market say? We have two types of measures. One is survey measure, the red line in this diagram. And as you can see, expected inflation by that measure has been going down, and is nowadays it's around 3%. If we go by the measure based on treasury bills or bonds, that the two types, the ones that are inflation proof and the others not inflation proof, and from the difference in the rates or the pricing of the two, one can infer what sort of inflation market expects. And inflation expectation has been around between 2 to 3%, and lately with the inflation moving up, expectation also has moved up somewhat in the past month or so. Okay, a couple more points. I'm going to come to this later on. This is the federal deficit, and I think it plays a role in inflation. In fact, it's pushing up inflation because the gap here has been not only huge in some years, but overall trend seems to be declining surplus, or more and more negative surpluses, which means larger and larger deficits. Okay, so let me summarize what we can learn from these graphs and information. High inflation seems to become ingrained and persisting in the US economy. So the question is, why is it the case? And it seems that past shocks actually started inflation, then the Fed and federal government increased spending, and that also fueled inflation to a large extent. And that has been working itself, those movements, those shocks seem to have been working their way through the economy. Initially, it was few products, and now it's many products across the spectrum. Aggregate demand remains strong. Aggregate demand has many components. Households had accumulated savings during the pandemic, and they've been spending that. That's probably declining in the coming months. Federal spending has been very strong, especially last year or so. as the new packages that Biden administration passed through the Congress had authorized the government to spend a lot, and that stimulus is continuing. I think that accounts for part of the renewed rise in inflation rate. Another factor is that towards the end of last year, we had sharply rising asset prices. Again, house prices to some extent, but stock market actually went up quite robustly last year. And when stocks and house prices go up, people feel richer, wealth goes up, and they spend more. So those things have contributed to aggregate demand remaining pretty strong. Also, the Fed has been cautious in raising interest rates to stop inflation because it doesn't want to risk a recession. That also prevents the aggregate demand from going down or restricting inflation too strongly. Is the Fed justified in the cautious way it's been acting? One can actually argue that given the outcome that inflation has started going up, maybe not. The Fed should have been acting much more decisively and should not have been giving any hint that it would reduce interest rates. But there are also some other considerations that I want to add at this point to show you the complexity of what's coming. Actually, aggregate demand may shrink over the coming couple of years, or maybe even just the coming year. One issue, as I mentioned before, is excess savings accumulated in the past. Those are being used up. People do all the sorts of traveling and expenditures with that money, and it's drying up. Its effect is going away. Asset prices may stagnate if people think that inflation is going to continue and therefore interest rates might go up, that asset prices may adjust downward. Stock market may not rise this year any further. And also, in the Fed, there might be some risk of tightening, although this, I would say, is low probability. One very key factor that may bring a recession is that at some point in the next couple of years, the government will have to cut back on its deficit. The US government, and this is true of many other governments around the world, if they try to cut back on expenditure, maybe raise revenues, that's going to be a negative impact on the market as a whole. And I think that might slow down the economy by itself. So the Fed doesn't need to do any other thing. And that's why the Fed is, so far, I think, has been justified in what it has been doing. So let me conclude. The inflation is up right now. And my sense is that the Fed will postpone any cut in interest rates, but the Fed also remains cautious and seems to be taking the position that it may cut interest rates down the road later this year. And that's going to be associated with declining aggregate demand through these mechanisms. The stock market stagnating, savings exhausting, and government cutting back on expenditures, raising revenues. And that, especially the issue of the government retrenching in the US, it's going to come after the election. The first year of the next administration is going to be a year of retrenchment. All right, questions, comments?
Is there a way to measure the what do you call the dip in the savings? How do they measure it? What kind of savings people have at this point in terms of spending, and when or how would it taper down?
I think one relatively simple way is to look at what proportion of their income people saved in the past when the economy was under different conditions, and try to see what would have the rate been if there was no shock and people were not given all sorts of stimulus support for dealing with the pandemic, and therefore you look at the actual savings in the past few years, you look at what your model based on past experience tells you, and that difference gives you an idea that there was an excess accumulation of assets or savings that households started spending. I think that's one way of doing it.
Okay.
Hey, Professor, this is Vivian. Hi, thank you very much for hosting the event again. I have a question regarding the last point, which is government deficit and how that is related to the Fed's action of either raising or cutting interest rate. Could you please elaborate a little bit on that?
The government action and what the Fed does, right?
Or the deficit part.
Right.
How is that related?
Now,
Thank you.
the US government and also many other governments in response to the pandemic really felt free to spend as much as they wanted. So suddenly expenditure just jumped up very sharply, deficits were huge, and that also was part of the source of the excess savings that household had, because they were given cash transfers, and at the time they couldn't spend much of it, so they postponed the expenditure till this year, last year, and this year, and that's being exhausted. Now, the government deficit, the way it is right now, has been rising very sharply, and government debt also has been going up. I think there's going to be a lot of talk about reversing this process, especially after the election. Right now, nobody wants to get deep into this. Even the Republicans who wanted to stop the government from borrowing any further agreed to come up with a compromise bill through Congress to avoid any shutdown or anything. But this kind of confrontation we're going to see arise in the next couple of years. So that if government expenditure goes down, then the economy by itself will move towards slowing down, or maybe moving towards the recession. So the Fed doesn't need to do anything, or the Fed, if it wants to keep the economy afloat, may have to lower interest rates. So that's the connection between the two. If the government continues to spend at the rate that it is right now, the Fed will have to keep the monetary policy tight, possibly even making it tighter.
Okay, got it. Thank you.
Sure.
Professor, what's your take? Should government reduce the spending, or they increase taxes to bridge the gap between deficit?
I think right now the US government is overspending. It's just, this is interesting. There's ideology, you might call it, or under political view that they have developed. In the old days, there was a lot of discussion about being responsible, fiscally responsible, and not overspending, etc. And over time, a lot of politicians learned that if you can justify your expenditure due to some crisis, then you get a free ticket to spend a lot and pass on the burden to future generations or to the politicians that come after you. So if you stay in office, then you deal with it then. If you're out of office, it's good that your opponent who won the election will have to deal with a very tough problem. So that's the view that a lot of politicians have developed around the world. To the extent possible, they don't mind continuing to spend. So I think sometimes it's necessary to do that. During the pandemic, it was a good idea to increase government expenditure and not worry about deficits and debt. But soon after, they should have actually slowed that down, that expenditure, because it can destabilize the economy, it can fuel inflation, and then when the time comes to cut back on expenditure or make the monetary policy more tight, that's going to actually hurt the economy in its own terms. So it would be best at this point if the federal government does not expand its expenditure anymore. Some taxes may need to be raised, that's true, but at the same time, taxes are not necessarily super low right now. So it, like, my own sense is that there's a lot more on the expenditure side that can be cut than tax raises that to reduce the deficit via revenue and the revenue side. Okay. Any other questions? Otherwise, it's almost time to say goodbye.
So one quick question, or more a little bit more like a request.
Sure.
So maybe we can talk about why people are so unhappy about the current economic situation, even though it looks like everything is so bright and sunny. And just I mean, there were like hundreds of thousands of jobs added into the market last week or something like that. Right. And then the salary, the income is increasing, things like that. But people are still so unhappy.
That's a very good question. Excellent question. I don't think we really have a complete answer to that. My own sense is that one of the key factors is that people get paid more and employment is good and they should be very happy. But when they go shopping, they see that prices have caught up with them. And that makes them angry because that feels like cheating. You give me a raise and then you raise the price of everything that I want to buy, right?
Right. Okay.
So I think
It raised my hope, make me temporarily happy for 2 seconds, and make me very unhappy for the rest of the day.
Exactly. That's I think one of the key problems. Inflation, it has been eroding the purchasing power of the money that people have been getting, and the sense that it feels like cheating, that they give you more salary, higher income, but at the same time your real income doesn't go up, or maybe even in some cases may have gone down. If you take into account house prices, for example, many young people who could have probably bought houses 10 years ago nowadays can't do that. This or equivalent people in the same stage of life. So that also doesn't feel too good. House prices, inflation generally, I think there's of course also people who are unhappy because of the way the benefits that come from government expenditure are distributed. They feel that some people get more than others, and that could be a concern for many people, that why government, for example, is giving these huge benefits to investors in AI or semiconductor industry in the US, and those billions of dollars that have been spent elsewhere that would directly benefit the other people.
I've put a link to a New York Times article in the chat that talks about the sort of the role of the what they call the Snickers bar inflation in the way how voters act. I thought that was very interesting reading, so I recommend this article quite a bit. So I think that might explain some of those issues that Hadi just talked about too.
All right. Thank you so much, everybody. Great seeing you, and thanks for the good questions. We'll see you next month.
Thank
And
you.
if you have
Thank you so
any
much.
ideas for future topics, if you can, sort of there is, sort of one thread with questions about what you'd like to see covered in the future in the group on LinkedIn, feel free to let us know, and we'll try to do our best to align the themes of those sessions if you're interested. Thanks, folks.
Thank
Thank
you.
you.
Thank you,
Thank you.
professors.
All
Thank
right,
you.
thanks. Talk to you
Bye.
soon. Bye.